Well, welcome back to the Real Estate Heavyweights podcast. And today we have an amazing interview. And I know I talked a little bit about him in the intro, but I will let Tavis do his part. This is a friend of Tavis, Brian Beatty. They've known each other for a long time. So Tavis, why don't you take it from here and get us started with Brian?
Good morning, everyone. So Brian Beatty and I have worked together for several years. I think going back to the late 2000s or so. And Brian is an excellent loan officer here in the DFW area. I believe you do loans even outside of Texas, don't you?
Yeah, I'm licensed in a few states, Oklahoma,
Okay.
Louisiana. Yeah.
Awesome. So yeah, Brian and I go way back when I was doing traditional sales back in the day, and have been in touch for many years. He's helped me with a lot of even personal conforming loans on rental properties that I own and things like that. So great wealth of knowledge. And one thing that I pride Brian for is he works backwards to forwards. So very close to the underwriter team, and is just one of those guys that is a fire preventer, right? So we try to handle any fires that may come up very early in the process. So anyways, felt like it would be great to bring him into the show today, especially with everything going on with rates and adjustments and things like that. And just wanted to get his insight of what's going on today. So Brian.
Cool. So
Awesome.
Take it,
Brian.
Brian.
Me, guys.
Yeah.
Thanks for having me, Tavis. I think it's been 2009 maybe when we started working together. You were kind of maybe newer into the industry, and I was getting my loan officer wheels going. I'd been in the industry since 2003. And I forget how we crossed paths, mutual friends somewhere, but I've worked with your wife over the years, worked with you over the years. Ashton, we did a deal recently together. That's great. Yep. Tavis, my one and only flip was with you. That was awesome too. So you kind of introduced me to that part of the real estate stuff. So yeah, excited to be here. Thanks for having me.
So when was your one flip? How long ago was that?
18 or 19?
2018. Yeah.
Okay. Yeah. So you didn't have a good experience? It was just too why is it the one and only? Would you do it again?
I mean, this might come off weird. I mean, it's decent money, but I wasn't into it to do it over and over and over again, which I think you have to do to make good money. I think we made like $35,000 on that deal and split it up. And that deal just kind of fell in my lap. We did owner financing for a friend of mine. His mom passed, and this house was ripe for getting redone. It was right in the heart of Tavis's kind of footprint of doing these things there in Plano, and it worked out really well. I made too much money or focused too much time on my mortgage business, and so I just more focused on that.
Yeah, makes sense. Yeah. Well, I got a couple questions sort of about the mortgage. Just can we start basic? Let's talk about some of the basics of how mortgages work. Because for me, as far as the financing goes, I've used hard money. I've obviously used conforming loan for personal residence and that sort of thing. But I'm always surprised to learn that there's just a lot of products out there. And so would you mind maybe just kind of doing an overview of some of the mortgage products that are out there and maybe highlight a few that I don't know if many people have heard of, but I mean, you've got FHA and VA, and you got conform, you got jumbo, you hear all these terms. And if you wouldn't mind, just kind of touch a little bit on the basics, and then maybe we can get into some products here. I wish more people knew about this, or if they knew about this going into it, it would really benefit them.
Sure. Well, there's hundreds and hundreds of investors out there. The majority of loans that are done for residential buyers are conventional loans, FHA loans, and VA loans. VA loans for veterans. There's also some rural property type stuff, USDA. That probably covers 90 to 95% of most of the loans that are done. And then there's what they call non-QM loans for, let's say, a self-employed borrower that doesn't, he's got a good CPA. They write off all the income on the tax return like a good CPA should do. So there's loan programs out there for them where we can qualify them based on basically the cash flow of money coming into their bank account. There's loan programs for wealthy individuals that maybe same case. they don't have a full-time job, or they just do special little projects here or there, and they don't have a qualifying income that a conventional loan would require. So there's asset-based loans. So basically we just add up all their assets they have, divided by a certain number, and can come up with a qualifying income number that way. There's loans for investors that are really popular right now called DSCR. It's debt service coverage ratio. You guys are probably familiar with it. Those are nice because they're easy. They're easy for everybody involved. There's not a lot of paperwork. It's not so much the borrower qualifying, although we do need to have a decent credit score and down payment. The qualifying part of the loan is based on the property. So as long as the property, can rent for a certain amount over the monthly obligation or the mortgage payment, then check, it's approved. So your investor needs to have a decent credit score. I think we've got them down to maybe 660 area. The lower the credit score.
What are you seeing right now for that percentage?
As far as down payment goes? Yeah, still.
No, sorry, the debt service coverage ratio. What are you seeing right now on that?
One is
qualifying?
Typical. One is typical, but there's a lot that'll go down lower. Some of them will just waive it altogether. There's not even a minimum.
Sure.
But that has to do with, does this borrower have lots of assets? And there's some other limiting factors at that. And maybe there's a little bit bigger down payment. But yeah, you can get into these without even having a coverage ratio, provided you meet some of these other things. But one is typical.
Sure.
Yeah, so.
Got it.
Yeah. Products, I mean, there's so many different products out there. It really depends. I tell people, hey, listen, tell me everything about your scenario. You might be apprehensive because you feel like there's an issue and you might not want to tell me about it. But I always tell people from a loan officer's perspective, I'm on your side. I'm here to help paint the picture for underwriting to try to get you approved. And there's things that if I knew, for example, I just had a loan the other day. These clients, they gave me like $890,000 worth of bank statements. And in a later conversation that the wife told me, she was like, yeah, my husband said, just give him what we think he needs to get this deal done. And I almost didn't get them qualified for this loan because I didn't know they had $3 million other dollars just parked in this account. And so the way that their financial planner had them set up they're retired, on taking their distributions, it didn't qualify them for a conventional until I discovered later that they had, $3 extra million in a bank account. And so it turned out to be a loan I could do. So I tell people up front, hey, give me everything. Let me figure it out. And I'll place you into the best program that, works for what you're trying to get done.
Yeah. I've got a question about underwriting. So on some programs, it seems that underwriting, whenever we're writing a contract, we'll contact the lender. Hey, how quick could you get this done? Can you get this done in 21 days, is 30 days, whatever. And I mean, I just had a Choctaw loan I've talked about several times on here, and I think it ended up taking close to 60 days. And so what are the factors that go into underwriting that kind of make some go super fast? Obviously more cash, the better, but why do some of them take a while and some of them can go super fast?
Well, there's a bunch of factors there. The loan officer plays a little bit of a role because if he doesn't set the file up correctly, and there's, a lot of back and forth between the original way we submitted the loan and how it ends up needing to get done, that could drag some things out. So the loan officer plays a little bit of a role. The company that you're working with, so for instance, you have so many people. Let's just say a company has 50 underwriters that work for them. Well, if rates drop like they're dropping now, and there's a bunch of refis that get into the pipeline, and that company can't pivot and add more underwriters to the equation, then the initial turn time, while it might be 24 to 48 hours, if they get busy all of a sudden, can turn into a week really quick. And how a management for the underwriters manages that pipeline is also important. So do they prioritize purchases over refinances, which they should? Do they look at conditions quicker than maybe they do the initial underwrite, which they should? So there's a lot of factors that go into it. If you have a messed up loan, that's typically, again, the fault of the loan officer that you just didn't put it together very good. I run a team of loan officers, and I hear all the stories of oh, this underwriter is no good or whatever. When I dig down into it, I'm like, well, maybe if you should have considered doing it this way, you wouldn't be into this problem. So I put a lot on the loan officer from that perspective, but
So
it's a group thing though. It
Brian,
could
you
be, but
you bring something up really good. I mean, because and I think this is something I was privy to early on in my career. Was Tabitha was in underwriting when I got into real estate, and that was 2004. And so, being married to an underwriter, I heard all the horror stories of the LOs calling her and complaining and crying and all the different factors. And she was the underwriter, and she was trying to, she always went into a deal trying to make it work, right? And that was always her approach. And some underwriters don't do that, but she would try to coach and educate and I'd always kind of reference it like, at the end of the day, it's the underwriter with the gavel, right? Like you can have the attorney who's the loan officer, talk about all this stuff and sell it and everything else,
yeah.
but it's all about how it gets presented. So can you talk a little bit about just like the structure of your business and how the process works? Like from loan application to processing
Sure.
to can you kind of just
Yeah.
for people that don't know that dynamic, just so they have a better understanding?
Sure. Yeah, it usually starts with a phone call between myself and the client, or the loan officer and the client, and so I call that the initial interview or initial consultation, and that phone call looks like this. It's really me just I'm scribbling notes. Everything they say, I'm taking notes, and a lot of, and they're probing questions that I'm asking. Like what's your expectation for down payment? As little as possible. You got money saved up. Tell me a little bit about that. That's kind of how I approach that. And then whatever they're saying, I'm writing down and getting as much information. And a lot of what I hear is some of it's red flag stuff. So so wait a minute, there's a divorce in the past or something. So there's things like that you need to vet. Are you actually divorced? Because if you're not divorced in the state of Texas, you got a problem, because it's community property state. We need a divorce. Otherwise, the other spouse has to be on that loan or sign a bunch of documents to not. So it's a probing question on that first interview. And then I point them to my website to do an official mortgage application. From that, if they fill it out correctly, I'll garner a lot more information. And part 2 of that application process is for them to upload their supporting docs. So we give them a list of income docs, asset docs, photo ID. I need to see all that stuff up front, and then we go through it with fine tooth comb. We'll look through the bank statements. It's basically just reviewing all that supporting doc, and from that, I can start putting together based on their goals too, right? So they might say, "Hey, I can afford to put 20% down, but I only want to put 5% down because I want to go use the rest of this money somewhere else." So we structure up a loan. I then have a second consultation with them. At that point, it's like a lot of verification and things that maybe we missed in the initial call, some other questions I have. But then I'll also present them with some numbers and make sure. That's important, that a lot of people miss, because they might have wildly different expectations on what it costs, right? So for instance, if you go online and you just put in numbers in a mortgage calculator,
Yeah,
a lot of times
I was going to ask that.
They don't have good numbers for taxes and insurance.
Yeah.
And so we see that a lot. It's like, yeah, you want to buy this $500,000 house, but the property taxes are $800 a month, included in this. So we go through that. I just, show them all the numbers. We get real honest with them up front, show them all the pros and cons. I usually do like 4 options for them. You can do this, you do that, or maybe we buy the rate down. If you're really payment sensitive, right, let's look at buying the rate down. If you're cash to close sensitive, then maybe we don't, and we look at how we can save a little more cash. So I'll give them those options, and ultimately they pick which mortgage option they choose. I just put together some different ones to kind of get them thinking.
Let me ask you this.
Yeah.
Can you talk about, I had this conversation recently with a friend. He's actually a real estate attorney, and I was not doing a good job of explaining it, of the concept, although I think I was right in what I was saying, is that like what you were just saying is if payment is really, let's say the bottom line is your monthly payment, how talk through the math and the logic of buying the points down versus actually asking for a discount on the house, and what kind of difference that can make for someone.
Yeah. So, well, it's definitely a good strategy today to try and, get a seller to provide, closing costs to help buy the rate down. It's rather than cut the price of the house, the seller can net maybe the same spot. But for the buyer, it's a big benefit to do that, because getting that rate lower might be, the thing that they need to do. The deal with points today is, we've since inflation started rising, there's what's called yield spread into an interest rate, and it's what's needed for a mortgage company to pay their loan officers, pay their bills, make a profit on the loan. Between that and points, so the combination of points and yield spread is what a mortgage company makes on the loan. But let's just go pre-inflation, those bonds had a lot of margin in them, so that we wouldn't have to buy discount points to make the amount of money that we need to make to stay in business, the mortgage company. Today, there's very little margin in these bond coupons. And so almost every deal that we write today has some version of discount points in it. And it's needed to get the rate low, because if you didn't have the discount points, the spread, for instance, let's say the rate today is 5.875. If I charge no discount point, the rate would likely be like 6.75. So now it's just a math equation. Does the difference in that rate, how it affects the monthly payment, pay for that cost, and how long does that cost take to pay back? So to simplify this, if it cost you $4,000 to buy down the rate to where you want it to be, and you get a $400 a month savings from that rate buy down, so that's 10 months until it pays itself off. So one of the questions I'll ask people is, okay, so what's the goal with the house? Are we going to stay here a couple of years? Is there job transfer in the future? A lot of times I hear, well, my kids are just entering high school, so we'll be there at least 4 years. And so that number is important when I go to set up the break-even point on these discount points. So it's really a very individual type question that I have to ask. Like, everyone's different. So is buying discount points worth it? Well, it depends is the answer. And so that's one of the scenarios I usually run through people up front, is the buy down part of things.
Sure. So let's talk about, well, let me ask this before we move to the actual interest rate discussion, because that's what's in the news today, specifically the Fed. It's a Wednesday. Fed is supposed to meet, I think it's Wednesday the 18th. Fed's supposed to meet today, supposedly going to drop rates first time since 2020. The market's already responded to dropping the retail rate, which is not directly correlated to the actual Fed, but it's how it moves. So we'll talk about that. Is there anything else from just sort of your business? Like, are there things that people, we always hear, like, don't buy a car right before you buy a house. So are there other things that you're like, maybe from an agent? A lot of our listeners are professional, either investors or agents. They know the business a little bit. So from our side, when we're educating buyers, is there anything that we could do better to prepare them to get a loan? And then on the retail side, is there things that people do consistently? Or like, I kind of wish this was different. If you would have done it this way from the beginning, we've gotten you a better deal or something.
The biggest thing is get them to a professional loan officer ASAP. Like, don't wait around for that, because there's a lot of things that will, could come up. And if we had more time, sometimes they're fixable, right? So get that pre-approval done ASAP for just about anybody. That's my number one thing to tell real estate agents. But for the most part, they're pretty good. A lot of you guys don't want to get in the car with somebody that's not pre-approved. But also, I've got some agents that, they'll say, hey, I've been working with this client 6 months. I think they're ready now. And I think to myself, man, 6 months ago probably would have been a good idea to talk about that. Because, and that's a big thing, in the market today. So many people are saying, well, I didn't want to buy back then. I didn't want to buy when rates were high, because rates are high, and I want to wait for that rate to be back to 3%, which probably never get to 3% again. But what happened, and I could show them mathematically, the home price went up 5-10% since they waited. And when I back into the math, unfortunately, their mortgage payment is higher than if they would have taken that 7% rate. I hate that date the rate, marry the house thing, but it's the concept is true. It's always better to buy the house, and then you can always refinance later. You'll always be, if you're working with a good loan officer, you'll always have the best interest rate available to you because you can refinance or don't refi if it's not worth it. But if like today, I'm doing a lot of refis right now because we closed loans the last couple of years at 7.5% interest rate. They're 5.5 now. So
Yeah.
So that would be the thing I would tell real estate agents.
Brian,
Get in
so
front of.
real quick, and I want to get into rate discussion and things, but talk real quick about the benefit of being, pre-underwritten approved or underwritten approved versus, just being pre-approved, and the misconception there. Because I know that truly to get underwrite approval, for clear to close, obviously there's a set of conditions and there's appraisal and things like that. But some people have that misconception, and then it just ideally, time frame of what some of that looks like and just the benefits to structuring it properly. Because I know we've done that in the past, right? To get ahead, especially in the crazy market, right? Of being underwritten approved was much more powerful.
Yeah. Yeah, so there's pre-qual, there's pre-approved, and then there's what I call TBD approved, which is an actual underwriter looks at your loan. So a pre-qual is essentially like, I don't know anybody that really does pre-quals. There might be some bigger banks or something like that does a pre-qual, but that's basically just taking your word for it, and you tell me, here's what your income is, and I do some math, and I go, oh yeah, you're pre-qualified for something like that. Pre-approved would be when I was talking earlier about going through that mortgage process, having those couple consultations with the client and having them do the application. That would be pre-approved, but that's just the loan officer pre-approving you. Now, there's a lot of tools. There's what they call AUS, automated underwriting system, where when we put in all the variables that go into an application, we run it through like a Fannie Mae or Freddie Mac AUS system. It will tell us if the borrower is approved. And I would say 97% of the time, a good loan officer, if he's done his due diligence with everything, that's not a problem. You're good on a pre-approval from a loan officer if he's good. But like you mentioned, Tavis, there's something called a TBD underwrite, or where we can get a full loan approval from an underwriter on the loan. So benefits of that. Timing, like you mentioned. So if we're in a rush to get some stuff done, maybe there's a multiple offer situation and we need to do a 2-week close on our offer because we feel that's going to be something the seller's going to like. I'll take that client, put them through a TBD underwrite, clear all of my conditions for assets, income, employment, and then all I need is property conditions, title, appraisal, and then that makes it quicker for us to close this loan quicker. The other advantage to that is, more certainty on the loan being done. So how about an iffy borrower? So maybe their credit is a little iffy, or they've got a job situation. Maybe they've changed jobs 2 or 3 times in the past 2 years, which is kind of frowned upon. And especially in an FHA world, maybe there's an employment gap, or maybe a change of income, or something that we're just a little uncertain about and how the underwriter is going to look at it. We'll package that loan up, send it to the underwriter, and have them look at it all before we're kind of getting our client out there to put offers in on contracts. So that's probably the number one example that I use that for. The TBD underwrite is, I got an iffy client. I'm not really sure I should send him out with my realtor to go look at homes and make offers until I get all of these things vetted out by the underwriter.
Well, the cool thing, the benefit of that, and Ashton, you've seen this in your contracts, in the 1 to 4, it actually, there's a clause in there that states, is it, are you contingent upon financing approval? So in something like that, right, the third party financing addendum has a number of days in there that you are set to get personal loan approval, right? That's for the borrower, not for the property. If it's subject to financing, it's still subject to property. Property approval being title and appraisal, unless you do a waiver and that kind of thing, which another set of addendums. But if and this was powerful back in the heyday of 2022, because you could actually do a financial loan and write it same as cash, because you could mark the box that they're not financially contingent. upon it because you had a TBD approval with the underwriter. So just something to think about, and for our listeners out there to understand.
Yeah, I didn't even know I didn't know that was possible, that you could kind of go ahead and go through the next step. And
yeah, because that whole addendum, a financing addendum, and the amount of days in there is all about personal financial approval. That's for them to approve the loan for the borrower, not for the property. And a lot of people get confused by that.
Yeah.
So,
no, that's good.
Yeah.
So let's talk a little bit about the market. Of course, I'm sure that's what everyone loves to talk to you about, specifically when they find out you're a mortgage broker, is like what the rates are doing, market's doing. So let's kind of set the stage a little bit over the last, like you said, inflation's gone up. They haven't cut rates since 2020, and then they've just steady increased. What were they at the top? Where were they? And we've come down obviously some from there, but
yeah, conventional loans almost 8%. So very high sevens in October 23.
Okay.
So we've come down 2 points already. This is like, I'm writing loans, some loans in the fives. Actually, to be honest with you, I'm closing a loan this week, 4.75 on a VA loan. VA's that low. Now he's buying 2.4 in points to get there, but that was, we ran the numbers for him. He feels like he's going to avoid a refinance in the future by paying those points today. So made sense for him. But the going rate conventionally is some banks are low sixes, some banks are high fives. So yeah, we've come down, just over 2 points already.
What do you think the target rate is, if you had to guess? I mean, I'm sure it changes with the different Fed chairs and administrations and that sort of thing. But what have you heard? We probably, like you said, we probably won't get back down to the threes or the high twos. So what would you think a target rate would be?
Well, funny enough, these Fannie Mae economists have been so wrong over the last 2 or 3 years. I mean, funny.
Yeah.
So I hesitate to share this with you, but I think the Fannie Mae prediction for the end of 2025 is like 5.5. But we're kind of already there. So what are rates going to look like? Who knows is the answer. I mean, it's very much economically driven. The Fed's lowering rates today, but today rates will be up. Believe it or not, it's the buy the rumor, sell the news type thing. Unless they cut a half basis point today, 50 basis points. I think the going thought is it should be 25 basis points, and that's 1:00 Central Standard Time today. That'll come out. So I don't know when this podcast drops, but if you're listening around then, check it out. But it'll probably be 25 basis points. There'll probably be 3 rate cuts this year. So the Fed will probably do it a couple more times before the end of the year. That's built into the market. That's the expectation. So the mortgage rates are traded off a bond called mortgage-backed securities. And it just like a stock, there's expectations up and down every day. And so it trades literally by the minute during business hours. And what do I think it'll be? I don't know. I anticipate we'll probably have some more Fed rate cuts in the spring. The election's a big thing to kind of get out of the way for a lot of reasons. My opinion is a lot of people are just kind of holding off to see which side's going to win. Funny enough, I also think it doesn't matter who wins. If you think Trump's going to help the economy and now I'll sell my house, or if you think Kamala is going to ruin the economy, I'll sell. I mean, I don't think it matters who wins. It just needs to be over with so people can move on with whatever they want to do.
Yeah.
But I don't know that I could put a number to where rates are going to be. My guess, low fives maybe next spring.
Yeah, I think the blip happened relatively fast. So I think a lot of people still remember they're still holding on to their 3% loans, and they've supposedly that's kind of what's locking up the market. It's like they just really are having a hard time coming to grips, and the numbers don't work out when they're wanting to go, they want to go save money or whatever, they reduce their mortgage or they want to get a bigger house. It's like, we just can't afford this. But if the delta between what they're locked up at and what the market's trading at is at least enough to where they can do that math, I think that could be, and it's recent enough where they remember where it was. If we had been 10 years into this and enough things had flushed out just with divorce and death and moving for school, and that not as many people had those locked up, I don't think it would be much. But so I do think that if we dip into that, you could see some people that have been holding off just jump in.
Yeah, for sure. Yeah. I mean, affordability is, believe it or not, a third of the purchases in our area are first-time home buyers still. A third's cash. So those first-time home buyers, there are a lot of them, and they're on the sidelines. They want to buy. And they're driving a lot of this demand at the low end of the market, but can they afford it, right? So these rates coming down are really, they're penny pinching type people. Their income's not as good as maybe a move-up buyer. So they're looking at these really close. And so, yeah, you're going to see a lot of demand coming in at the bottom end of the market for, because of rates coming down.
Well, I'm sure refis, right? Well, I mean, I'm sure you guys are hoping, for the rates to drop as well, because anybody that's financed anything any purchases within the last, year and a half, right? You're looking at anything that was in the 7s to up to the 8s, right? Well, definitely
kind of a small window. 22, 23, and this part of and up to through 24. Those people have a rate that's probably refinanceable, but also, cash out refis and equity loans, debt's as high as it's with the inflation. And what the other problem in the economy is people are putting all sorts of stuff on their credit card. So with rates coming down and them able to, in equity high in homes, people are able to refinance, pay off that high interest debt on their credit card and kind of reset. The other part, to go back to what you're talking to, Ashton, is, why we're locked in. If you look at, it's been probably since 2008, 2009, when we had the mortgage crash or real estate crash, rates have been fairly low, 4s and 5s, throughout this whole time. So people don't know any better, right? So that main buying, the millennials that are buying right now, that's all they know. And so when they see a 6% interest rate, while that's still below the 80-year average, they're like, I don't want to spend that, right? So they don't know any better. But your parents, my parents, they probably financed their house at 12, 13, 14, 15%.
Right, in the 80s, yeah.
Yep. I think Ben Baker got on here. That his first house he was talking about, they financed at 13%, and it was just insane to even fathom that.
Yeah. So a lot of what I'm doing today is even educating buyers on what home prices have looked like over the past 80 years and interest rates, because. But just a quick stat to throw out: if we look at 80 years, there's 73 positive price in home appreciation years and 7 down years. It's a hell of a record, right?
Yeah.
So when people tell me, hey, I think I don't know if I want to buy right now because I'm afraid home prices are too high, I'll show them those stats year by year. I have them and I'll show them to them. And then I show them interest rates and I tell them, well, if we average rates out over, last 80 years, 6.875 is the average interest rate. So where we're at today is not out of this world.
Not bad. Yeah.
Well, and I would imagine, I don't know, from a value standpoint, a negative value, probably the one of them that we know about is in the 2008 era, and that was a policy failure. It wasn't necessarily a market thing. That they've made a ton of changes on policy that probably made that negative. Now, I don't know before that what the economic factors were going into, probably some wars or something like that, but
Great Depression.
Depression. Yeah. So it's very, very rare. And that's the thing we've talked about here. It's like, I think you hit on it, is a lot of people, well, I'm going to wait for rates. Well, the thing is, if everyone's waiting for rates and then a bunch of people jump into the market and all those people are going after a limited supply of houses, then demand goes up and prices go up and your net number is probably similar. And not only that, but the basis for tax and everything else is higher. So it's not necessarily like you just really want this to happen. So, but there's just a weird, it's like the marketing firm for mortgage rates is doing it. It's out there, and like everyone buys into this idea that, hey, lower rates are better. And, enough people believe that to where it's kind of locking things up. So it does seem like maybe, well, it'll loosen things up and, hopefully it kind of moves the economy along a little bit, and we'll see.
Well,
stop listening to the media and start listening to professionals like us, because the media. Oof.
Yeah. And Brian, when, what do you think what do you normally tell people as far as when rates drop? What do you think is recommended to even inquire, look at a refinance that makes sense?
Yeah.
Is it a point, a half point? What do you typically recommend that's
it
worth considering?
Depends. Yeah, it depends. The general rule that's out there is 1%, but there's people that have like an $800,000 mortgage And if a 0.5% move saves them, enough in that monthly payment to afford the cost of it, then it makes sense. The real question is, how long do you plan on owning this home? And that goes beyond how long you live there, because you might keep it as an investment property in the future. But how long do you plan on owning this home? So now I've got that number, and then it's just math. Here's the cost of the refinance, and here's what the monthly savings will be. We just do the math, and if the break-even point works, then it works.
Yeah.
So, but to answer your question, somewhere between 0.5% and 1%. I would say 1% is an okay, thought.
Makes sense.
Yeah, if you can lower it 1. Yeah.
So I know, and we'll wrap up here in just a little bit, but I know you're a mortgage broker. You get to kind of look at the marketplace and compare a lot of different shops that are, hey, we have this rate and this many fees, and you're kind of looking at the net number. To me, it seems obviously like a no-brainer to go with a mortgage broker over a local bank or something like that. But what is your sales pitch to agents or other people that are kind of comparing you to a bank? What are some questions they can ask to say, hey, this is what you want to know about what you're getting into, and this is why I'm different there?
Go with the loan officer versus the company behind the loan officer more often than not. And the good loan officers are going to be with a retail correspondent lender or a broker. I have my company's a broker correspondent. We're kind of quasi both. We actually fund and close the loans in our own name. But I have the ability to shop around with 250 different investors. There's advantages to both. I came 13 years from a correspondent lender. Some advantages with a correspondent lender are, you got your one underwriting manager, your one, management team that's operating things. So it's easy to, if you have an issue, to contact that person and, try to handle that stuff. There's some myths though about brokers. Like I have a way better, I close faster at my brokerage. And a lot of retail people will tell you, you can't do that. And that's because the retail people don't want you to use a broker. They make more money off of you as a loan officer if you keep it in-house. But yeah, so I can close faster, and my interest rates are really good. So that's why I made the move to the company that I'm at today. But the real thing for a realtor to know is, do you trust your loan officer? Can they get stuff done? And I like what you said earlier, Tavis. Yeah, I'm a fire preventer. That's a really good way to describe it. If you start there, the company really doesn't matter too much.
Nice.
Yeah.
Well, Tavis, do you have any other questions for Brian? You want him to talk any about flush anything out that we've talked about, or
what about BAC? What do you got?
Yeah. Well, yeah. No.
Let's do away with it. Screw those agents. We don't even need it.
I texted you that yesterday, so I'm so glad you brought that up, because knowing the lending world from my perspective, for years, obviously being married with Tabitha and her journey in that world. So if you guys don't know, conventional financing in the history has allowed buyer concessions up to 3%, and FHA has allowed up to 6% in buyer concessions. Now, these concessions are typically in our contract 1-4, 12A, 1B, typically outlines in regards to closing costs and prepaids as far as credit being allowed to be used to the buyer. The seller's paying for it hypothetically. Again, it's all into the purchase price of the deal. So the buyer's paying for it. It's just the way that the deal is structured and where the credits come from on the HUD, right, or on the settlement statement. And the best way I can always reference it is very similar to buying a car, and you decide to roll in tax, title, and license. So you have purchase price of the car, $30,000, tax, title, and license, another $3,500, and you basically roll it all in. As long as the car will appraise or the bank will allow a loan, you can essentially, finance the car for, $33,500, which includes everything in it. You may be upside down, right? Is why they have gap insurance. But anyways, just in comparison, that's how that works. So, Brian, what do you know about the new controversy with BAC, with buyers having to pay the buyer's agent commission if by chance that the seller does not allow this and does not have this predetermined or preset, or there's not a broker, a broker co-op agreement in place.
Yeah. Well, from a lending perspective, I can tell you, and if there's any loan officers out there listening, if your management hasn't taught you to start paying attention to this, you need to, because so it came up with one of my loan officers last month. Just give you the quick story on what happened. We got to closing and realized that, yes, there was an agreement between the buyer and the buyer's agent for a 3% commission. The seller, however, was only offering a 2.5%, to the buyer's agent. So what happens to that other 0.5%? Well, it has to be paid by the buyer. We found out at closing because the cash to close number was higher than what was expected by everybody. And this was just news to us. And so it kind of caught us off guard, and we're like, aha, so now we need to start paying attention to this. We need to ask up front, hey, do you, this property? Well, we can look at the contract in Texas. Some states don't have it, but in Texas, I think it's page 10 in the TREC contract. It will list what the seller's offering the buyer's agent. Mike,
well, that's only in there if it's a co-broker agreement, though. Otherwise, you need to look at Form 2406 and then 2401 now, which is addendums. So if it's paid from the seller as a buyer agent or as a concession, then it is going to be additional addendums. It won't be on page 10. If it's a co-broker agreement, meaning it's 2406 and I think it's 2402, is that correct,
yeah.
Ashton?
Yeah.
Then it would be on page 10. But it's not always going to be. And that's where they need to figure that out, because right now it's like there's too many options.
Yeah, and they're going to fix it.
I think they're filling it out to see how things go. I'm more a fan of listing commission gets set, and then there's a seller concession that's allowed, and do it that way. I think that's a cleaner version. EXP went to that. So like if there's any listing right now, EXP kind of set their agents up and say, we're no longer doing a broker to broker agreement. So there's no longer commission being paid for by the broker or predetermined by the broker. It's basically, we have a listing agreement, and then if the seller wants to allow concessions towards BAC, then that could be structured that way.
But does that get in the way of certain loans that?
Well,
finish your story on that.
The bottom line is the loan officer has to know who's paying commission, who's getting commission, because let's just say the seller isn't paying any commission towards the buyer's agent, and there's an agreement between the buyer and the buying agent, then we've got to factor that in our pre-qual up front, because that's cash to close that he's got to come up with, or we have to come up with a structure to try to work this in. And there's a couple, different things I can offer on that, but yeah, it's important to do it up front in your pre-approval now. You need to.
So it's almost so as a loan officer, it's almost important for you guys to see what the buyer's agent rep agreement in a way, right?
First realtor we asked for a copy of that. They said, "Why do I need to give you that? That's none of your business."
Wow.
I said, It is now. You better believe it is.
It is now. So let me ask you this. So let's say that it is a situation where let's max it out. Let's say that it's a conventional loan, or even FHA. Let's just say it's FHA, because that number is going to get big pretty quick. So FHA, you got a concession allowed to the buyer, because the buyer needs closing costs, 6%, right? Then max it out. So it's a $300,000 deal. They put $18,000 in there, right, for concessions to in 12A1B, and then they have a buyer's rep agreement in a 2401 that the seller is offering 3% towards buyer's agent commission, and that now there's let's say
9%
total. Yeah,
that's not a problem. You can do that.
Oh, really?
Okay.
Is because what Fannie, Freddie, and FHA all came out when all this was getting settled. They all said the seller paying the buyer's agent commission will stay the same as it has always been, and it will not count towards those max concessions that you were describing earlier.
Okay.
So 3%.
So as long as it is technically coming as a buyer or a seller credit, then that can be done that way. But if it does lean towards a buyer paying it and the seller is not offering any kind of concession, then in that case, the only way to do that is the buyer has to pay it out of pocket. Is that correct?
Correct. Well, yes. So,
okay.
Yeah, just to be clear, whatever is in 12, paragraph 12 on the contract, that's your limits, right? So you can only go 3% on conventional, 6% FHA. By the way, conventional, you can go more if the down payment's more. So like 10% down conventional, you can do 6%.
Oh, really?
Okay. Yeah. So there is, if the down payment's higher, you can go higher in the concessions, but that's your limit. And then if there's additional for the buyer's agent, it can be additional without counting against the loan.
Got it.
Now, if you have a situation where the seller is not going to pay any commission, so what options do we have for the homeowner? It's really now try to get them in 12B, but that usually involves, hey, if I got a $600,000 purchase and I'm paying my buyer's agent 3%, I'm going to need to raise it by $18,000 the purchase price. Problem with that is you run into potential appraisal issues, right? So that'd be nice if you could do that in all the deals, but
and that was my next point is if it is most of the time, I mean, right now the market's a little softer. We're a little more of a balanced market right now. So I think concessions for closing costs are a little bit more acceptable. You know, the last couple of years, is a deduction of net to the seller, right? So unless it did appraise, in the past, we used to look at it, when I got in the business in 2004, $100,000 deal, and you'd have you would need closing costs. And so we'd look at it and go, okay, we can give the seller what they want. They're asking $100,000. Will it appraise for $103,000 if we get $3,000 credit from the seller, right? Or a $5,000 credit from the seller, and therefore we would, increase the sales price to 105, to cover that, right? As long as it would appraise. So I think we're going to see some of that right now. Again, I think it's important, as a listing agent, just to have these discussions with your seller.
We need to retrain the appraisers like they were in 2007. Get a little bit of those creative appraisals going. That'll figure all this out. Nothing will go wrong with that. That'll be great.
Yeah. Yeah. Except those numbers were like, let's inflate it by 100,000 and then just do a cash out refi.
Yeah. Well, I mean, it does. I will say this, going into all of this over the last 6 months, all the speculation, consternation of what's falling apart and this, I will say after doing a couple of deals, writing up contracts on both sides, listing and buying, it is smoothing out. It does seem that the lending world, they're getting their stuff together and everyone's, kind of feeling their way through it. No deals are seemingly falling apart because of the commission, structure. And what we've heard from, I think, Keller Williams in a couple of the trainings that we've been in is I think that the state is, the next time they can make an official change to the contract, it seems that there's going to be some more clarification on the contract. So maybe some of these addendums aren't even necessary, that we can just kind of clear everything up on the contract and just make it where everyone's kind of on the same playing field, because the 2406 and 02 and all that, a lot of brokerages and even smaller brokers who aren't getting a lot of the training just aren't either using it or they're not familiar with it. And then it's our folks at the office saying, hey, they have to sign this. We require this now. So it's all ironing out. And
I do think
right.
Going back to what Brian said, I think it's important. Make sure your loan officer has this information up front. Cause we heard this from another agent in the office that, for instance, the seller was willing to offer 2% or, 1.5 or 2.5. And so the buyer was paying the difference, which most buyers seem to be okay with that, of paying that part out of pocket. But it is very important for the structure of the loan to know, because in the past, you guys basically look at two things, right? If you're getting a loan, it's basically, okay, how much money are you putting down? And then what are the projected closing costs and prepaids?
Sure.
And that's your cash to close. And all of that goes into the loan structure. And there's all these disclosure factors, right, that you have to put that in the original application, and that has to match within reason up until, prior to closing, right? And there's an amount of days that you have to get that all out and signed. And so if that isn't disclosed, that additional money that can throw the whole thing off, right? Because it could change a lot of factors.
Yeah, well, for sure. Fortunately, we're not beholden to if we miss your commission because there's some fees that if I don't put it on the appraisal, for instance, if I don't put the fee on the initial loan estimate and it's just I forgot it, then I've got to pay for it. So thankfully, your commissions aren't, but they are on the settlement statement. And when it all foots out.
Oh, Brian's going to start paying commissions.
Oh, that'd be great.
So, yeah,
that's what I'm hearing.
Everybody send your loan to Brian. He's going to pay your BAC for you. No problem.
That's a great thing.
No. Retract. No, but it is important that we know that because, like in my example, that 0.5% difference, it hit the bottom line for the cash to close, and fortunately, we had enough funds verified because you have to verify all these funds with the underwriter, and so they can't just say we'll pay you on the side. It's part of the transaction, and therefore the underwriter needs to verify those assets. So it should be on your loan estimates up front. It's certainly going to be on your closing disclosure at the end. So make sure you know about who's paying what on the commissions when you're, pre-approval in these deals. And I mean, you really don't know, I guess, until they pick a property. But you need to be aware of it up front that, they've agreed to pay you 3%. And you might be shopping for homes that aren't going to have a seller concession on that side for your commissions.
Yeah.
Awesome.
Nice. Well, Brian, did you grow up in Dallas? Or you always been from the area or?
No, I'm actually from Ohio, Northern Ohio.
Okay.
Yeah.
But you
Browns
came down here
Indians
just to work?
Cavs fan.
Oh my God.
Yeah, well,
I would say that's really sad to be those fans, but at this point, the Cowboys fans basically on the same level as all that. Yeah. Bernie Kosar, those are your heydays right there.
Those
Bernie
are my
Kosar.
heydays, mid 80s for sure.
Yeah. Nice.
But I'm a glutton for punishment. That's why I'm a loan officer too, and I've taken it. I'm always constantly getting beat up over my fandom from Cleveland. But no, I've been in Texas since '95. Yeah, I actually went to college at UT Austin, and got a job up here in Dallas right after that.
Nice.
Been here ever since. Yeah.
Well, we are the real estate heavyweights, and we do talk a little bit more and more about restaurants. So just give us your real quick. What's your go-to, client restaurant? Splurge a little bit, go have a good time restaurant. You closed a really good deal, and you're going to go celebrate a little bit. Where do you go?
Yeah, gosh. Okay, so any of the steak restaurants in North Dallas. So, Three Forks, Capital Grill. I love Capital Grill. There's basically any high-end steak restaurant.
I'll send you a link. We've talked about it a couple of times. There's a new Asian fusion steakhouse that's coming in, the most expensive build out ever. The owner, it's the CEO of Smoothie King, built this. I think it's called Nori. I've said it 9 times. It better be getting it right. There's a $20 million build out, and it's supposed to be really, really nice. The renderings and pictures look beautiful. So I'll send you that one, and we'll have you go check it out at some
Listen,
point.
I'm a big guy too, so let's go get some.
Let's go get some steak. Yeah, we'll roll in there. Yeah, we're the type of guys that roll into one of those all-you-can-eat places, and they start getting a little bit nervous. So, well, Brian, thank you so much for. Thank you for being here. Thank you for taking the time. You really explained a lot of things. I've had a lot of questions about mortgages for a long time, so definitely appreciate it. What's the best way for people to get in touch with you? Social, phone number, or email, anything like that, whatever you want to share.
Yeah, I'll share my phone. It's 214-448-4641. That's my, cell, text, call anytime. My wife's got comfortable over the years. This is a 24/7 job, so weekends are fine. Or you can email me at brian@thebeattyteam.com. Brian@beattyteam.com. No doubt.
Brian@beattyteam.com. Awesome.
Yeah.
Well, thank you so much for your time.
Yeah.
For those of you who have not yet, please like, subscribe, follow the podcast on YouTube, follow us on Spotify or Apple. Copy this link, send it to a friend, especially this one. If you've got a friend that's in the real estate business, other investors, there's a lot of different things that they're going to learn here. And if you've got clients that are looking to buy, this explains a lot about why they're given the certain paperwork, what the inner workings behind the scenes are, and I think it could be super educational for them. So copy a link, send it to them, and until next time, have a great day.